First up, we talk about the markets, and it seems like the bears have taken a grip on Dalal Street for the month of October. So far, in the month of October, we've seen the Nifty lose more than 5 percentage points, making it the worst one since March 2020 by way of performance in a month. And we're talking about the COVID pandemic. When you compare it to, we're looking quite weak. And from life highs just a month ago, now the Nifty is down 6.7%. And it's not just the benchmarks, the Sensex and the Nifty. If you look at the broader markets, the small caps and the mid caps, we've also seen them turn in their worst performance monthly in a span of 2 years. So what are the stocks in broader markets that are leading the kind of fall that we're witnessing? And what are the monthly trends so far for the mid cap and small cap indices? Let's find out first from my colleague Ansh. He's got the details and we'll go across to him. Ansh, tell us, what's it looking like? These stocks that are leading the fall in the markets, which ones are they?
Well, Nifty is down by more than 1% today, but if we talk about mid-cap and small-cap, those have given sharper falls. Let's talk on monthly basis. Mid-cap is down by more than 6% on a monthly basis, and it has formed a bearish engulfing candlestick pattern, which usually indicates a potential reversal in trend on downside. The index has snapped its 6-month gaining streak and has registered its biggest single monthly fall in at least 2 years. And out of 100 stocks for Nifty mid-cap 100 index, we are seeing 85 stocks are actually declining. Now, if we talk about small cap index, then even small cap index has been declining for second consecutive month, and it is down by more than 5% on a monthly basis. Like mid cap index, it has also registered its biggest single monthly decline in at least 2 years. The top losers for small cap index are Manappuram Finance, HFCL, Mahanagar Gas, NBCC, and IFCI.
Thanks for that, Ansh. And even while you're telling us about the stocks that have led the fall, I was looking at the International Monetary Fund, and what they're saying in their latest report is that India's GDP growth outlook looks at where it was. They've retained that outlook at 7% for FY25. Yet at the same time, they've downgraded China, and they've downgraded it to 4.8% for the current year. And this after the latest stimulus package coming through. So we need to put that in context, because recently, we've seen how attractive the Chinese markets have looked to FIIs, and this sell India and buy China kind of credo. Perhaps this IMF report answers it. But what's happening in our own markets? That's the big question. Let's connect again with a market expert, a veteran in his own right, Ajay Bagga, joining us. And with him tonight, we have the head of research and partner at Manhattan Venture Partners, Santosh Rao, also on the show with us. Gentlemen, good evening. It's great to have you, but Ajay, coming to you first, we spoke about this only yesterday. We were discussing the reasons why FIIs are pulling out of Indian equities in a big way. Now that we are seeing another sharp crack in the Nifty, we need now to double down on that question. Are India's slowing macros the real reason? You spoke about it yesterday. Are the effects of slowing consumption, the higher input costs, the rising competition, is that more evident now in the Q2 numbers than they have been in the recent past?
Yeah, leading indicators were already showing a declining trend. Again, it is a growing economy, and instead of 7%, will probably grow at 6.5 or 6.6% in real terms. So it's a declining trend. It's not that the economy is in stall mode or anything. But because you're priced to perfection, Vikram, the problem is the valuations at which the Indian markets were at. And when you don't deliver on those very elevated valuations and elevated projections, then you see a sell-off like this. So it's been a function of some global issues, be it the rise in the US yields, be it the rise in the US dollar, in decreasing path of the Fed rate cut with good, robust US economic numbers. Second, the Chinese stimulus. You saw $53 billion going into China targeted funds in the first 2 weeks, right after their stimulus announcement. After that, a bit of reversal did come in, but a lot of money did go into China. And then third is the India macro itself and sluggish earnings growth. So across sectors, if you see, especially the consumption-focused sectors and the very highly valued sectors, both are having an issue. financials, because they have underperformed and they were overweight in FI portfolios, we have seen a bit of selling in the financials from FIs. A lot of numbers are showing 23,000 crores of FIs selling in the financials, but they were already underperforming. And that makes them very attractive now, as I mentioned yesterday as well.
Indeed. Santosh Rao, do weigh in on this. You think this is a temporary blip in the markets? Because for the longest time, we've spoken about the strength of the Indian markets, the promise that the Indian economy holds, especially when the chips were down globally. India was standing out. Do you think that that's still the case? And this is a temporary blip?
Yes, I agree with all the comments that Ajay just mentioned. Yes, I think it's a temporary blip. We were priced for perfection, as happens every time. The market overshoots when times are good and undershoots when and goes really deep down when things are bad. So it's always like that. So you need to come to an equilibrium at some point. And I think India is going through that process. It was very rich in terms of valuation. It's still rich on a relative basis compared to other emerging markets. But I think it's a fundamental story. The secular story of India is very good. There is growth in the market. There's a lot of manufacturing coming in. So all those things are good for the economy. So it'll come back. But I think you can call it a minor correction, a healthy correction, much needed correction. It always is good. And if you see the bright spot, even the IMF projections, India is still the best growth market. And you'll continue to see that. We did see a lot of pull forward when the COVID happened and all the demand for that to kind of make up for that. But now things are settling down.
Yes.
So we'll get a steady state at some point pretty soon, I would say.
Yes.
But this correction is okay. That's it happens.
But
and also
what are
with
the
the China thing,
fundamental
there was a
issues?
knee-jerk reaction.
Yes.
So market money went flowed there, then it kind of slowed down the China where money flowing out, and it'll come back again because at the end of the day, India is the best market in terms of outlook.
But what if there is a fundamental issue with demand? And Ajay, do weigh in on this, because you know what holds true for auto and consumer companies today, where margins are getting squeezed, where volumes are becoming a challenge because demand is not rising at the pace that it was. Can this be extrapolated to what's happening perhaps in the rest of the Indian economy? Even if you look at banks, you mentioned banks, especially the PSU banks, for the kind of euphoria that was building around them. Now, the question is about the valuations, even over there in the financials that you were talking about. How stretched do they look?
Yeah, Vikram, first I would say you must see what Mr. Rao mentioned on the secular story. You are not getting another story of this scale with this kind of growth, with this deeper market, which will go on to double, triple over the next 10 years, 12 years. This kind of opportunity is not there. So yes, we have seen $10 billion going out, but you look at the amount of the market cap that India represents and 18-19% of that being FI, it's very small in that sense. Now coming to demand is an issue, and the biggest driver of that has been the national elections. Normally what happens, Vikram, a lot of money moves from the formal sector into the informal sector in terms of dole-outs to voters during national elections, and we see an FMCG bump up. We didn't see that this time around. And secondly, the capex of the government really fell through because of 3 months of non-action due to the government formation and then post-government formation projects being given out. Now, the first half has been quite dismal in terms of government capex. Secondly, government expenditure itself has not been catching up. Now, those two are going to catch up very fast in the second half. The target is 40% year on year if they have to meet the budgetary deadlines. I don't think they will meet that. But the pool, Vikram, represents about 29% of GDP, is the state and the central government capex. And if that happens in the second half, a lot of it will happen. It will get spent. That will give a multiplier into the economy.
So you think that's going to happen in the second half? But we have the ongoing issue of inflation, especially food inflation, and our interest rates are still elevated. Both of them affect demand, don't they?
Yeah, that is affecting. That is a drag. And if you look at the urban demand, that is languishing at 4.5%. The rural demand has picked up due to a good monsoon and expectations of a good harvest that will start coming in now. And you will see that difference coming in terms of the pickup. There are 35 lakh weddings planned in November, December, Vikram. You're going, and that's why, people have been buying the jewelers like crazy, buying the retailers like crazy. You will see a lot of discretionary and a lot of marriage related expenditure. You don't have another country where you have access like this to data and where people are free spending. So you have to look at the top 4 crore Indians, which are the real premium. There is a slowdown there, but they were really carrying in the post COVID. They really carried. Now we are coming into the affluent segment, the mid tier, I would say about 10, 12 crore Indians. Those are going to do the heavy lifting now. And there is a problem. There is a problem with the rest. There's a long tail which is living off subsistence, agriculture, and dole outs.
Yes.
So we are seeing a slowdown there. And that is a trickle down. When the government spends, Vikram, you see that coming back and coming in. No one else can really take care of such a long tail. That, in a nutshell,
Yeah.
is what's happening.
So you're saying that the kind of secular growth that you can expect in the Indian economy perhaps stays unparalleled at this stage. But even if you were to consider the strong fundamentals, Santosh Rao, how do you rate the ability of the Indian markets to absorb disruptions like Trump as US president, whose tax and tariff policies, they may lead to higher inflation, and as an extension, you could have higher interest rates for a longer time in the US, which means higher bond yields and a stronger dollar. Is that going to affect emerging markets like India?
Yes, the headline is that tariffs are bad. They don't work. They are inflationary. And we don't need that at this point. But I think right now, this is election season. Everybody is throwing out everything out there to get their votes. So it's a very close election. So tariffs, I don't think you will see tariffs the way it's being pictured in the media. I don't think it's going to be that black and white. It's going to be selective, targeted. Talking to a few economists on the Republican side, that's what they're saying. It's more targeted, even though he has said that it's going to be broad-based, but he's using that as a negotiating tool. So yes, tariffs do raise prices, but the last time he did institute tariffs, it did not do too much damage. The Biden administration kept those tariffs, so things are working fine. So I think there has to be some kind of an equilibrium there. So he's going to be selective in what he does. He needs to do that. If not, it is going to slow down the growth, cause inflation, and all the other effects. And that is going to have a ripple effect across the world. So I think hopefully, after the election season, after the silly season is over in terms of give outs and giveaways, the freebies, we come back to real basics, because the US needs to get its house in order. The fiscal deficits are out of hand. The economy needs to be straightened out. The tax cuts that were instituted, they expire. We need to see whether they will be renewed or kept. Trump wants to reduce it more, actually, not just renew it. So things like that, but we don't know how much will pass at that one point. Right now, it's all about getting elected.
Do you agree with that, Ajay? Do you agree with what Santosh Rao is saying? Because the resilience of the markets and economy are going to be tested on the basis of how well they are able to withstand external disruptions. How well are our own markets poised?
Yeah, it's a truism that what politicians rhetorically say during elections and what they, in a very balanced manner, do when they are sitting on the chair, there's a big difference. For example, Big Pharma, who has been able to touch them or bring down the healthcare costs? So, these are all political rhetorics. Yes, there will be some amount of tariffs, and even the Biden administration has tried to put some controls on, say, semiconductors to China, or through the Inflation Act, fund their own manufacturing to come back. But these are very small, very small actions overall. A big tariff like what Trump has been talking about, that would disrupt the US economy totally. And there would be a very big blowback on that. And it will disrupt global supply chains. So it's not very easy to unravel what has happened over the last 30 years, the hollowing out of Europe and US, the huge capacities that China has built up, and the scale that China has. So you take EVs, for example, Vikram, they have control on 80-90% of certain minerals globally. Even Indonesian mines are being owned by the Chinese, operated by the Chinese. You look at mines in Africa, they're owning about 40% of land in Africa. Nearly 60% of natural resources in Africa are controlled by Chinese companies now. So it's not going to be very simple in just tariffs. You will have, the goods going into a Vietnam or a Mexico or some other place and getting stamped as made in Vietnam, but a large portion would have been still made in China. You will have workarounds like that. It's happening in India also. Even in our defense industry, if you see, a lot of Chinese goods manage to come in with stamps of some other country.
Right.
So not that simplistic.
Yes.
But it spoils the environment. But again, we go back to fundamentals, go back to earnings.
Yes.
I think we were in a frothy zone. The good thing about this market is everybody is skeptical about the Indian market, and mostly the Indians. We go and put in 21,000 crores a
But I
month
don't
in
see
SIPs.
skepticism when you look at the monthly SIP inflows. That's not where skepticism is evident, Ajay.
No, that's exactly what I was saying. We do put in 21,000 crores. But we like to be argumentative Indians, so we go and criticize the markets and that this is a gambler's den, but we are putting 21,000 crores. So FIs might have gone out. 420,000, 4.2 lakh crores have been put in by DIIs into this market, and that number is growing.
So you're
Your
not
pension
expecting
funds are coming.
Yeah, so you're not expecting any correction anytime soon, any stark correction in the markets.
No, it's very possible. Every night we sleep, we don't know where Iran will wake up and where Israel will wake up. So corrections will come. We have no control, geopolitical risk or any of this disruption. Oil, we are so dependent on oil. If those prices shoot up to $150, all bets are off. So corrections will come. And maybe this correction will double from here. We are 7% down. From the top of late September. Maybe we'll see another 4-5%. Very possible. But does it change the thesis of India or anyone looking at medium to long term? Will they change their outlook on India? I don't think so. And again, I'm saying this opportunity is a generational opportunity of scale, of growth, and of depth. All three.
Is there a need to make any contra calls right now? Very quickly, Ajay, we are out of time. In the current market conditions where consumption is not the strongest, IT's comeback is still looking distant. Bank stock valuations seem a bit stretched. What do you suggest?
I would say IT and financial. IT and private banks, both are contra calls. Nobody likes them. FIs have been selling them. And especially private banks have underperformed. Nobody believes in their thesis. They will fund this economy. So those two, and then capital goods.
Right.
If my thesis is last 6 months, government is going to ratchet up you will see a lot of order flows, and the capital goods have a lot of operating leverage embedded in them. That will lead to a big revaluation in those. And power, again, capex is happening, be it transmission or be it renewables. I think power and the financiers of power, the erectors of power, the suppliers of power, I think all three we can look at.
Thanks very much. That's very enlightening. It's always good to have a conversation with both of you gentlemen, Santosh Rao, Ajay Bagga. Thanks very much for joining us on India Tonight with a look at how the markets are performing and what we can expect of them in times to come.
If you like this video, then like, share and subscribe to ET Now.